I wonder if maybe we could start like kind of right on time. So we have to
Yeah.
I know, I have a lady. And they're kids. And so the name goes, yeah, like little kids you in. Because the word cloud is kind of more fun if you're using the same words. Oh, so I remember.
Yeah.
Otherwise-
No, I'm not the holiday.
Yeah, I'm gonna say, you know, I can get it. Did you change this one? Did you put that up there?
I just changed it.
That's so cute, yeah. Cause I put like the sticker one on it and the round one. Awesome. Yeah, maybe we'll get started.
Got 15 people in the online.
Yay. Awesome.
Yeah.
All right, well, we can go ahead and get started right away because I have a bunch of slides, right? So I'd like to get through them and leave plenty of time for Q&A. So I see a lot of familiar faces and a lot of new faces. So just for the people, the new faces, I'm Sara, Glakas. So I'm one of the founders of the Austin Women's Investing Group. My friend Michelle and I started the group back in 2011. So we've got like over a decade under our belt of having these monthly meetings. And so just for people who are new, like the whole purpose, the whole reason the Austin Women's Investing Group exists is to get a bunch of women together in a room to talk about money and finance and investing. That's it, right? So when we first started, we would meet in each other's living rooms with like cats and kids like crawling all over everybody. We'd bring a couple bottles of wine and just talk about whatever came up. But as the group grew and grew and grew, you know, we discovered that there were women in Austin who wanted to get together and talk about money, right? So since then, we kind of outgrew all the coffee shops, we outgrew all the spaces, and now that we're back in person after the pandemic, we try to hold a lot of our meetings at the library, right? It's free. Like this is kind of like I don't know, like it's, a lot of people like to mix like wine and wealth, but we're just kind of here to work, right? You know, we're here to work and we're here to like put in the time to learn this thing. And it's great because, you know, we want to be supporting the Austin Public Library. They've been great hosts for us. Hey, everybody. So let's see. One of the things, like right off the bat, just so you can kind of be preparing, that we do before all of our in-person meetings is we're going to go around the room and just really quickly, because we'll probably have a big group, just everybody, just because one of the points of the Austin Women's Investing Group is to learn from the people next to you, right? Like we're all here with different levels of experience. I'm a financial advisor. I've studied finance. I've studied the markets for, you know, however many decades I've been doing that, but a lot of people haven't. So we're here in the room together to share experiences. We're also here to ask questions. So some people like to preface their questions with, I know this is a dumb question, but don't do that here. There's no such thing, right? So whatever the language is, however you get the question out, I guarantee you that another person has the question. So go ahead and ask it. Anyway, so we start each meeting with what's your name? What do you do during the day? How did you find our group? What are you hoping to learn? Right, so we can get to know each other a little bit. There's people in this room who've made like really, really amazing connections with each other, just knowing those basic facts about each other. Let's see. One other thing we've never had a problem with, but I've felt compelled to say this since 2011, nothing in this group is intended to be individualized investing advice. I am a financial professional. Sometimes we have people who get up here and lead a topic who are not financial professionals. They're just like sharing their passion and their knowledge. But I am. So everything that I'm talking about here is my opinion. I will offer my opinion, but nothing is like, go out and buy this stock, go out and buy this fund, go out and do this. If you need individualized investment advice, call an advisor. If you need legal advice, call a lawyer, right? If you need tax advice, call a tax person. But in here, you can ask the questions and there might be people who have that knowledge. What else? What have I forgotten that I normally say for those of you who are normally here? Was anyone here? Was anyone here that year that I forgot to book the room? And there were like 50 of us and we all showed up and I was like, just totally forgot to reserve the room. And like, we went over to the Carver Museum and they had a room for us and they're like, well, the limit is 25. I'm like, I think we have 25. We had like at least 50 people, right? And so people were sitting on the floors and in the hallway. So I was really happy when I walked in today. I was like, yes, we have the room, right? We have the chairs. Okay, anything else before we start? No, is that
Yeah,
it?
you covered it all.
All right, cool. So we're just gonna go around really quickly. Again, share as much as you're willing to share. I would say, because we're such a big group, trying to keep this thing moving. But so just these 4 questions, and then hopefully, I'll start the slide deck. My hope is that as slides come up and as I go through what I want to cover, that you'll feel empowered and encouraged to ask questions in real time as things come up. The stock market is definitely a topic that has a little bit of a language barrier for almost everybody. It's something that people typically don't feel really comfortable with. That's the whole point of this meeting, right? Is we're trying to get everybody up to speed on either getting comfortable with the stock market, or if they don't get comfortable with it, they know why, right? So, Tammy, would you like to start with introductions, and we'll kind of like zigzag around.
So my name is Tammy Miller, and I run a local Austin nonprofit organization here called ATX Kids Club. We work with children. And I found the group because Sara and I have a long history. She actually helped us way back in 2018, I think, with our strategic plan, and then has just been great. Her daughter has been in our program. And I'm hoping to learn a little bit more about what type of a person invests in the stock market. Like, where do you need to be in your financial portfolio to say, yep, I'm going to dive in?
Cool.
Yeah.
Awesome. Thank you.
Yeah.
My name is Radisha, and I work at a nonprofit. I'm a manager at Girl Scouts. I found this group on Meetup because I'm a new Austinite.
Ooh.
Learning my way around, and I am hoping to learn maybe, I guess how to get in, because I at least know boards and just want to transfer that knowledge to us.
Cool. Awesome. Welcome.
My name is Nova, work in tech during the day, also found a group through Meetup. Hoping to learn, I don't know, diversifying strategy, yeah.
Awesome. Welcome.
Yeah, I'm Leanne. I'm currently on a leave of absence from my job of 11 years, trying to decide if I want to go back, if I want to do something different, if I want to retire. Just kind of trying to figure all that out. Found a group through Meetup, and hoping to learn. I did jump into the stock market around pandemic time, and most things I did, I've been real successful, and I'm happy. Just kind of learned, on my own, just, YouTube videos and different things. And I feel relatively comfortable, but not 100%. And I did I was hoping to buy a house, and with prices going crazy, so to answer the one about hoping to learn what to do with that, like emergency fund money. So it's not just sitting there anymore as far as, either retirement or.
Awesome. Welcome.
I'm Jen. I am an accountant for a small business here in Austin. I found the group through Sara's UT informal classes a few years ago now.
Yeah.
Those don't happen anymore. And I just wanted to learn more about the stock market and investing and the new investor. So
Welcome.
I'm Ronnie Rivera. I am a information data analyst for the state in the cybersecurity area. And I found this group from my friend Susan here next to me. And I'm looking to learn, like Leanne said, what to do with that emergency money that's been sitting there forever.
Welcome.
Hey, I'm Irene Murphy, and I'm back. So came back again with Susan. I am a realtor here in Austin, but I started investing when I was in tech. I was in tech for 18 years. and always learning new things from Sarah. So happy to be back with the gang and want to see what 2024 brings.
Welcome back.
Thank you.
My name is Susan. I'm in sales. Myself, fasteners, screws and tools. Stanley Black and Decker. Sarah's been a godsend to me as far as helping me. I was in a bad situation financially. And I had an investor who was my best friend's husband and I trusted and I didn't understand. And so Sarah got me out of it and said, you can do this. And I took a class of and been attending and I'm totally managing my own stocks. Thank you for everything. And they're doing well.
I mean, you guys, Susan got herself out of it.
You know, thank you.
Susan's done the work.
But you talk.
Yeah.
You talk.
Thank you for everything.
Well, thank you for
She is
coming
great. When you don't know what to do, Sarah can sit down and work with you and getting a plan together on how to best move forward so that you can retire. So it's not, you're in a habitual state cycle of working. And so we're working the plan and it's working. So thank you for everything.
Thank you. So kind.
Hi, I'm Kim, and I am in between jobs, so I'm very adamantly looking for my next role. And I'm in high tech, so I have good investments that could be better. I'm 56, so I'm looking for what my next chapter is going to look like from an investment perspective and retirement and, recurring income, possibly things like that and what to do with it. So I'm looking for knowledge. And Susan invited me.
Wonderful.
And I invited her to the whole.
Yeah, right.
Yeah, things can happen.
Wow, you're
I'm Nicole Scott, and sorry I was a few minutes late.
No worries.
But I'm glad to be here. I'm in a bit of a transition myself. I've been in corporate marketing for 25-ish years and decided a couple of years ago to go back and get my master's in social work. And so with my conversations with my girlfriend here, I'm wanting to kind of bridge those together, and I'm hoping I can maybe I'm thinking about pursuing like corporate social responsibility. And I've had a lot of success working for big companies. But I think that's a really important topic right now for helping people, women in our communities. And so in terms of investing, I just want to learn, hear what you have to say. I have not been, I'm a big investor, but I haven't been investing myself for the last couple of years. I've been spending, on my education. So that concerns me a lot that the last couple of years which are important. I'm 50, almost 53. I put that on pause. And so, sometimes you wonder, am I doing the right thing? Investing in myself in that way. So I'm really interested in learning something new. Welcome. Thank you.
Great. Rebecca.
My name is Rebecca Dreiling. I'm a personal assistant to two high net worth individuals. I found this group through my friend Jeff, and I feel like I'm on the precipice of financial freedom, and so I'm hoping, I don't know what I'm going to learn, but I feel like this will help me get closer to that.
Welcome.
My name is Jessica Alonza. During the day, I am a physician at the hospital, I work as a hospitalist. I found the group through a friend / colleague at the hospital. He sent me a link and told me about you, and so that was just last week. So here I am, my first class. I'm hoping to learn, honestly, just some basic terminology with stocks. My dad had started a little small financial portfolio for me before he passed away. And now it's there, and I just want to manage it wisely. So we start off by understanding it.
Wonderful. Perfect. Welcome. What a cool connection.
My name is Jan, and during the day, my husband and I have a business, an online business, so I have time to research. How I found out it was through you. I took your class, yeah, a few years ago, and I've been investing on my own ever since. What I'm hoping to learn is how to not lose money.
Oh, no.
But I've also, so I'd like to know when to say it's time to sell and not hold on until
yeah.
it loses value.
Yeah.
Yeah.
Remind me about that event.
My name is Gayatri. During the day, I work in the data and tech company. I found it really to meet up as well. And then what I'm hoping to learn, I have some investments in the stock market, and I've been learning. I started my job less than 3 years ago, my first job, so I've been learning how to manage my money. But I want to learn more about investing in the stock market independently, and also just have a group from whom I can learn and discuss stock market investments and financial side of it.
Okay, thank you.
Hi, I'm Peggy Archer. I'm a retired nurse. I met Sarah through her UP classes, and I'd like to learn how to keep my investment working for me so I can stay retired.
Perfect. Welcome back.
Thank you.
I'm Lisa. I work as a digital product manager on mobile apps and during the day, I'm recently divorced. So everything now is about retirement and need to make new plans. Yeah, I have something there, some projected, but not in the same place I was. And the person is extremely long. And I'm hoping just so I don't know a lot about investing except for what up to 7.
Perfect. Welcome.
Hi guys, I'm Rachel. I'm a realtor at Compass here today. I found this group through an attorney that referred me to Sara and Casey. I wanted to talk to them. I really don't know anything about stocks. I'm not gonna lie, and I don't have a super diverse investment portfolio, but I'm hoping to. Last time I learned a lot about topics that I didn't think I thought I knew about, and my education, and hopefully this year put some stocks. I don't have any right now.
Rachel, before we move on, can you tell everyone in here what we're launching in 2024 with you?
If you are interested in investing in real estate, we're kind of doing a little subgroup off of A-Way. For women who want to learn more, whether it's how to buy a property, how to invest in real estate, how to do your EV, things like that. What we call A-Wire, and we're going to be running it together. And so if you have any questions, please look out for that.
And the next meetup next month will be Rachel presenting.
Oh, that's right. In February, preview,
Yeah.
real estate investing.
Yours will be going by really fast. If one of your new goals is like how to buy a house with your, I'm in the A-Way group, but we're gonna start another little Facebook group off of that, but you're welcome to reach out to me on the side. My name is like Rachel and so, or feel free to just search my platform.
Perfect. So excited about that. Kate?
Hi guys, I'm Casey and I work at Blackburn Financial with Sarah and Gwen. And I'm a financial planner. And so that's what I do during the day. I found the group on Meetup, just like everybody else, like 10 years ago. And this is one of the ways that I think Meetup is awesome, is that Sarah and I were friends forever, and I worked at a different company. And then when that company went more corporate, then I was able to leave that company and join Sara as a partner. So the two of us are at Blackburn Financial now, and I absolutely love it. So what I want to learn, okay, so here's something that I want to learn from all of you guys who are really like, already retired or like are close to their FIRE goals. now that I am a business owner, I know it's awesome and we're doing great and everything, but like my income went way down. How do you like live through the hard part? It's like when you first join the gym, right? And you're like, God, these sit-ups hurt so much. Like, how do you get through that? That's what I want to learn.
We'll talk about 2022. We all survived, we're all here.
And you're still friends after being friends with business owners, you know.
I knew it was meant to be.
Folks, my name is Courtney. I also found time to meet up. By day, I work in biotech, but I'm trying to not work as soon as possible. Because I just hate sitting in front of a computer for 8 hours a day and it's destroying my will to live. And I'm only 38, so really trying to figure out how to make my investments free so I don't have to work, so I can play. And I'm so impressed how young you are. I mean, I was not attending these 2 years, 2 years into work. And I'm a volunteer financial coach with Foundation Communities, and so.
Love foundation community.
Yes, and I absolutely love that role, and so it's exciting to have a group of people to talk about money with. We've had 10 friends who are really sick of me.
Yeah.
So,
Why the group exists.
especially during the live things do, so.
Awesome, welcome.
Hello, I'm Sherry.
You know my name.
My day job is graphic designer, and I've been with this group for many years, and over the years, I think one of the best part is look for conference and support when market is down.
End of year 2022 holiday party. Girls.
And I'm always thinking about celebrating when market is up, and this is the best group to celebrate with. And yeah, I mean, this is empowered group. I just feel so glad to be part of it. So, yep.
Well, welcome back.
And thank you.
I did see an Instagram said that the market just hit its all-time high.
Yes. Don't look at it. Don't look at that. All right.
I'm Mary Grace. I'm an office manager and executive assistant. And I found this group a few years ago and found sporadically, so I'm meetup. And I'm on the fire journey and I'm hoping to maybe quit my job as soon as my birthday, 34.
What fire stands for?
It's possible. It stands for financial independence, retire early. So I've been heavily in the stock market only for a handful of years. And I just like to be a part of the investment community, especially women focused groups, kind of give back and read and learn from other people. So I'm more hoping for a community.
We all want to buy it.
Someone's gonna lead a fire topic.
Hi guys, my name is Francine. I go by Francine Peter. During the day, I am a project manager at a tech company. I found this group through my wife, meetup. And I'm very interested, we both are, to actually like learn for other women, like how to successfully invest, diversify. I tried to play the stock market, but it seems that I only lose money. Hopefully, you know, I can learn how to stop doing that and start thinking more like long term instead of like I'm losing money, let me pull out money and go our son. So glad to be here and like meet more like-minded people, not only losing money, but
Hi everyone, my name is Kelsey Strova. I work at Johnson & Johnson and I oversee pharmaceutical manufacturing, so this biotech, I resonate with you. I found this group from a gal I do yoga with. She sent it to me and I'm kind of surprised I haven't discovered it sooner. So this is our first time joining one of these, and my
similar to current things. We just really want to learn what to do with our money and where it goes. Currently we have one investment property in the stock market. I'm a little bit better in the stock market than he is. But we want to be better and, you know, diverse and promote new ideas. And, yeah, hoping to learn more ways to invest.
Welcome.
Thank you.
Hi, my name is Lisa. You know, I've been Venmo for a while, but always do online. So in person, like, hey, this sounds like, oh yeah, I want to come in person. You know, we same thing like with this year investing. So during the day, I'm doing bookkeeping part time, and then so yeah, get to learn more about investing.
Perfect. Welcome.
Thank you.
Hi, everyone. My name is Susana. During the day, I have two jobs. One is I sell IP to companies like Amazon and Samsung for higher ed. And then I'm moonlighting as a leadership coach. I've been a coach for about 3 years now. And I think I joined the group back in 2018, I want to say, through a colleague who recommended it. And then I took Sarah's class at UT on learning like basics of stock. And the stock that I picked at the time just hit triple-digit growth.
Yes.
I can't with high market yesterday, and it's like, oh my gosh, okay, I'm doing something right. And now what I'm hoping to learn going forward is how can I stay aggressive, but really understand what I'm investing in. Like, how do I analyze, right, a company and the valuation? So, and always learning about how they report. The one thing I also want to say is, somebody mentioned divorce. My mom got divorced after 47 years of marriage. She's in Mexico and she was left with nothing. And I was grateful that I can support her while we fight through lawyers. And just realizing that life will hit and just an emergency fund is all important. So it's just now like I'm grateful for all the advice I've received from Sarah. Thank you, and will continue to receive. And excited to learn more.
Welcome.
You know, my name is Melanie. I've been helping for a long time. And I'm always working with family businesses, so there's no pension, there's no 401k, there's not much structure. I've turned 50 this year, and I've been in this group to meet up during pandemic times. I'm hoping to learn what analysis paralysis is not doing for me. And I've just turned to CDs and I got on the IBOM train, which is okay. But I realized you have to be open to some loss and I would holiday tuition. I'm willing to pay some tuition if everything works. But I also study this student group. I do not go online and play gaming, but my friends are like, oh no, I should. And I'm like, I would rather have some y'all help if I talk about this. I would rather learn this game because I think there's possibility I could support myself. That's what I'm.
Welcome back.
Hi, I'm Sarah. Thanks for sharing. During the day, I work at a real estate company that does loans for investors. I just got promoted to a junior loan officer, which means I'm making a little more money, but I'm working way harder. But yeah, I've been in this for about a year, and I'm hoping to learn. I have analysis paralysis. I'm definitely like over researcher. So I have money sitting in my IRA and I need to get it allocated. So that's what I'm looking for. And then also I'm interested in like the specific stocks. I feel like a lot of people don't want to talk about that, but if anyone wants to, or fun, anything on word. Yeah, and then also, so I love, if you ever heard of my rich BFF, she just wrote a book about money.
Yeah.
And I went to her seminar and she said something really cool that I want to share. Basically, she said like the richest people aren't the smartest people, it's just gonna advocate for themselves. And I was like,
Cool. Awesome. Welcome back. Leora, you sat right in the seat for the next one. So. But you've done this before, so.
I'm new to business. I'm a software. I've been things for a couple of years now. I think it was right before COVID. Yeah, I was the last person meeting for COVID. I enjoy national personal finance. I'm passionate about
raising other people's level of financial awareness and what that for finding back to people and networking they can.
Perfect. Welcome.
Yeah, you're up.
I'm Fiona. I'm actually was introduced to stuff by Laura. What I do during the day, I'm actually just started well, three months. I'm a physical therapist, but I transitioned to some nonprofit engineer with Laura. So I had made I kind of with Laura and then what it is that we learned. Hoping to learn more about investing and being more confident in my ability to learn about it, not something like I don't understand it or something. It's not something I can understand, but I know now that I can. And so I have one win to share is that I went to a financial planner a long time ago, really in these funds and realized I was being charged a fee and doing some research, realized how much that fee can affect your gains. So I finally pulled the plug, got myself a little Fidelity account and transfer that money didn't transfer now. So I'm like, that's a win for me. I didn't know what to do. It was bad. I didn't know what to do.
Yeah.
So I want to learn more.
And then you did something.
And I did that.
Yay. Awesome. Well, welcome back. I think we have the rest of the A-Week team over here.
And I am one of the co-organizers. And I'm going to be working with Rachel on real estate stuff because I have two rental properties. And obviously I'm novice at it, but still like to discuss it. So our plan is to have first, Rachel's going to talk about buying a house. And then we're going to have a meeting where we talk about real estate investing. And then we're going to start having like a group that gets together to talk about that. You'll get more details about that. Mainly, I haven't figured them out.
Try to do the whole group.
I'm a software engineer, not working right now. My dad was interested in stocks and savings, and so that's where I got basically my knowledge and impulsion to do it. What would I found it through Meetup, just looked on Meetup for a women's group that was dealing with financial issues. And what I would like to learn today is like, while the market's up, what do I need to be thinking about? Should I be figuring out what I need to sell off and then looking for low hanging fruit, sell off and keep it until it goes back down? It's like, what should my strategies be like right now when it's really high? And do those strategies involve buying another rental house?
Hey, save it for February. Awesome, thank you.
Hi, everybody. My name is Gwen. During the day, I work with Sara and Casey at Blackbarn as their executive assistant. You'll see me, I'll be in the kitchen here because I'm manning the tech. So we've got, I think, about 25 folks that are tuned in through Zoom. So they kind of have their eye on Sara and they're able to see the slides. So we're joined by a host that we cannot see, but they're in the room with us. What I'm hoping to learn. I'm always open to learning just any bits of information from Sara, from folks that come to the group. I think today my main takeaway that I'm hoping for is, as a millennial, I feel like I fall prey to a lot of doom scrolling and kind of like, ruminating on my future and my financial future. I find that the antidote for that is to actually talk to people in person and hear other people's experiences of, how they're able to conceptualize a plan for the future and not make things a lot better about the future. So that is hopefully going to be my takeaway. I always find that I feel a lot better about the future and things like that after hearing from folks in my group.
Awesome, thank you. All right, thank you, everybody. Yeah.
So I have one last thing I forgot to say. Somebody brought it up and I'm just remembering. Ethical investing, I feel like, I think that's really important.
Yeah.
I'm just curious if you can actually be an ethical investor and make money.
Yeah, on all of these fronts.
Yes,
One more thing.
and then the other thing I want to learn is crypto,
Yeah,
because that's my next jam.
yeah. Okay, so for on all of these things, you guys, the best thing, well, one of the best things that ever happened to the Austin Women's Investing Group was the pandemic. Because we were forced to go online and we recorded all of our meetings from March 2020 until the beginning of last year. So all of these things, we have Casey sitting right next to you, has 2 videos online about ethical investing and socially responsible investing. So we have, yeah.
It's the only thing I do.
Yeah. Okay. We have a YouTube channel that has all of these videos. I think there's a crypto one on there as well. So we have real estate, crypto, just the stock market, like a bunch of different stuff on our AWIG YouTube channel. We have a Facebook group, a private Facebook group for sharing ideas. And then of course we have the meetup group where that's kind of the main hub. So however you came through, those are kind of the main sources of information. A couple people mentioned the classes that I used to teach, informal classes. It's no more. They did not survive the pandemic. But I'm really hoping to put classes back together this year. And so obviously this group would be the first to know if people are interested in that sort of thing. So it's not happening yet, but again, it's just like getting more resources in the hands of more people. We have been really trying to do that so that, you know, if you like this group and you want to go back and see what other people have talked about, we have what, 30 videos up on our YouTube channel, and it's cool. So hello to everybody online. Gwen will be monitoring that and throwing out questions. Without further ado, I've budgeted 15 minutes for introductions and we're 35 minutes in, so we're going to jam through some of these slides. All right, so I do this like every January. This is my favorite meeting of the year. It's my favorite topic of all time. Important information to remember. Nothing in these slides are intended to be individualized investing advice. The other piece that's really important that financial people always say is past performance is not indicative of future results, right? That means like the future is not going to be exactly like the past. One of the things I love about investing is it's forward looking, right? So the analysis paralysis, the wherever you are, the whatever mistakes that were made are in the past. And in finance, that means they're completely irrelevant. We're starting here and we're going forward. So we're trying to collect information to help us make the best decisions we can moving forward, right? That is something that sometimes investors have a hard time doing, moving forward, right? We get stuck in the past. So that's what I love about the stock market. That's what I love about investing. So we use information from the past to try to make forecasts, predictions, good guesses about the future. There's lots of other little bullet points. You can read them when these slides go out to the group, but we may as well just kind of start going. This is me. We've already talked about me a whole bunch, so there we can just move on. All right. So just to level set things about the stocks, or the stocks, how I talk about stocks, it's stocks for the long run, right? To me, the long run is ideally 20 years plus, at least 5 years, but it's many years. So it's not day trading. It's not short-term swings. You're going to get whipsawed. It's just the nature of the stock market. We'll talk a little bit about that. Whipsawed means you buy high and sell low, right? We're trying to do the opposite, right? Buy low. So here's a couple quotes from Uncle Warren Buffett. On the top, you shouldn't own common stocks if a 50% decrease in their value in a short period of time would cause you acute distress. There's almost no one that doesn't apply to. Right? It causes everyone distress, but it is important to remember. We'll look at some charts. Second, this is my very favorite investing quote of all time. Someone is sitting in the shade today because someone planted a tree a long time ago, right? So coming back to, if you're trying to grow something, it's going to take time. And if you want to get that time started, it's now, right? Ideally, it was 20 years ago, right? But the second best time is today. All right, so let's move forward. All right, so again, just kind of level setting some very basics about the stock market, a little bit of terminology. What are stocks? What is the stock market? So when we're talking about stocks, another word is equities. We're talking about stocks. We're talking about ownership of a company. Ownership is super important. I'm an owner of a company. If I don't make more money than I spend, I get $0, right? If I'm a lender, I lend someone money to buy a house, they have to pay me back or they go bankrupt. It's a different, it's just a different situation, right? So as an owner, you are trying to own the stocks of businesses that make money. Seems like kind of intuitive, right? But it's not necessarily what we try to keep top of mind. The price of a stock. So you guys, most of you, like some people have mentioned like, hey, stock market's at all-time highs, right? Like maybe you've seen a ticker where you see the price of a stock going up and down during the day or over the course of a year, whatever it is. That price is set by the market. We are all the market. Everyone who's a participant is the market, right? The price of a stock is simply where a buyer and a seller agree to make a transaction. So in the US, the stock market is open from 8:30 Central to 3 o'clock Central. And that's when most of the people are assembling together to trade stocks. You can do a little bit pre-market, a little bit post-market, but those hours during the workday is when most people get together to trade stocks, right? And so it's just, you have some sellers coming in, you have some buyers coming in, wherever they agree to make a transaction is where the price is set. You can think about it like in the terms of like buying and selling a house. You can list your house for whatever price you want, but the price of your house is what a buyer will give you for it. You can say, my house is worth $1 million. If you can't find someone to give you $1 million for it, it's not worth $1 million. It's worth something less, right? If you have a bunch of people coming in and offering more than $1 million, then it's worth more, right? So that's how prices are set. There's no other third party. In the stock market, what we're talking about, there's not a ton of manipulation either, right? Because there's too many people to manipulate. It's supply and demand. Stock prices are always changing because investors' expectations about the future are always changing. So again, this comes back to the stock market is forward-looking. If you are relying on something that is happened in the past or is happening right now, you're too late, right? Everybody's trying to make these predictions about what's going to happen in the future so they can get in front of these changes in prices. Again, that's something very confusing, right? So just as we go forward, the two major components of those changing expectations in stocks are something called earnings that we'll talk about. Earnings are, another word is profits, net income. We'll look at that a little bit closer. And then there's like this other kind of nebulous piece that I kind of labeled confidence. You know, how confident are we about the future? When you are confident, you are willing to pay more for something. This is true for everything, right? And it's definitely true in the stock market. The less confident you are, the less you're willing to pay for something. So those two things combine with each other to create stock prices. And it's why stock prices go up and down so much. All of us as participants are making this assessment every second that the markets are open. What do I think earnings are going to be? How confident am I? Right? All the time. So both of those things fluctuate. That is why, for most investors, the stock market is only appropriate for long-term money, right? These expectations are shifting continuously. And we don't find out if we're right or wrong until the thing happens. And by that time, it's too late. So we're trying to stay in front of a change in expectations. Any questions on that so far? I went through it kind of fast. I have some charts too. Oh, also, if anyone wants to move, I do have charts that you might want to see closer. So if anyone wants to move forward, please feel free to do that. All right, so this is an earnings statement. So I just said one of the two major components of stock prices is earnings. Luckily, right now, we're in the middle of something called earnings season, right? This is when all of the publicly traded companies start telling us how much money they earned last quarter. So they have to say that publicly. If a stock is publicly traded, which are the stocks that we're talking about here, then every quarter they have to give us updated information on how their business is doing. So at the very top of an earnings statement or an income statement or a statement of income, statement of earnings, profit and loss statement, something like that, at the very top you have revenue. Revenue is also known as sales and the top line because it's at the top of the income statement. Think that revenue is you walk into the Apple store, you hand them $1,000, they hand you an iPhone, that $1,000 is booked as revenue, okay? Next, a company has to pay cost of goods sold. How much did it cost to make the thing that you're buying, right? So that's kind of the cost of raw materials. Company has to report how much they paid to make the iPhone. Next are operating expenses. So I always think of this as the cost to keep the lights on. And it's mostly tied to the people that are running the company, right? So payroll, benefits, rent, software, utilities, things like that. The company has to pay those people, right? You guys are all operating expenses, or most of you are, right? Next, a company has to pay interest on any debt that it's borrowed. Next, it has to pay taxes if it owes them, money owed to the government. And after all of those other people get paid, then you have something called earnings at the bottom. This is where the stock market gets annoyingly confusing because we call it earnings, but we also call it profits, net earnings, net income, and the bottom line, because it's at the bottom of the income statement. It's the money that's left over. This is the money that the owners have a claim on. It's not necessarily the money you get, but it's the money that the owners have a claim on. So this earnings number is what is the most important number for stock investors. For bond investors or lenders, this number is the most important. They want to know that there's money to pay them. We want to make sure that after all of these other people get paid as shareholders or stockholders, is there money left over in profits? Another number that comes out, if you take earnings, so the big number, and you divide it by the number of shares outstanding, you can think of a stock share as, have you ever seen like a stock certificate? You can like buy them on eBay. People don't have paper certificates very often anymore. But it's a piece of paper that says, hey, I own 1 share of this company. I am a tiny, tiny percentage owner of this company. They keep track of the number of shares outstanding. So if you take the earnings number and divide it by the number of shares outstanding, you get something called earnings per share, or EPS. So I don't mean to like overwhelm people with terminology, but this is something that if you are into individual stocks, every quarter, the company that you're looking at reports this and talks about it. If you're serious about individual stocks, mark your calendar. They tell you when they release their earnings, and they tell you when the conference call is. You can jump on the conference call. You're not gonna be able to ask questions, but you can listen to other people ask questions. So this is all information that is available. It's not a mystery. It's just buried in the overwhelming amount of information that we're all inundated with. So you have to look for it. Okay, it's knowable. Yes.
So in this context, I hear often like EBITDA being an important.
Yeah. EBITDA is important up here. It stands for earnings before interest, taxes, depreciation, and amortization. So it's the number here. It's like it's a fake number that it's not GAAP approved. Sorry, that's generally accepted accounting principles. But that's the number that lenders look at because that's the number that a lender would make sure they were getting paid. So sometimes it's reported. Yeah.
So I know there's no dumb questions here, but
No.
So when a business is publicly traded and they decide that they now have shares that people are going to be able to buy, it seems as though there's an infinite number of shares available, which is not possible, right?
No,
So,
there's a finite number of shares that are published somewhere.
so there are actually publicly traded companies who no longer have any shares for people to buy?
Oh, no, like there are shares outstanding, like Johnson & Johnson, maybe it has 500 million shares outstanding. So you might have some, I might have some, we all probably have some, right? We can trade those with each other. They're outstanding in that they're available to be traded, not available to be issued. Does that make sense? So it's like we all have shares of Johnson & Johnson in the ETFs or exchange traded funds or mutual funds we own. We might have individual shares. We can sell those to each other or anyone else. That's the number of shares outstanding. And it's recorded by the company and published by the company. I think it's one of the main ones, like if you go to like Google Finance or Yahoo Finance, it's published. For our purposes, it's actually not so important.
Right, okay.
Really, like this EPS number is important, more important than the number of shares.
When companies like Google split that then creates more.
It creates more shares. It doubles them and then the price gets cut in half, right, to compensate. Really good questions. All right, next. So we kind of know where earnings come from. Yes, my favorite chart. All right, this is my favorite chart. Those of you who've done this with me before, taken a class, you've seen it. This is updated. So this is this very, 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 very important relationship between price and earnings. So what we're looking at here is the red line is S&P 500 earnings. So S&P 500 It's a list of 500 large US companies that are picked by Standard & Poor's. They're the S&P. This is a benchmark we use in the stock market. It's just like a big basket of stocks, right? So you can take those 500 companies and you can add up the earnings that they generate, right? Because they report them quarterly. So again, that's a knowable number. So this red line is the actual dollar of earnings that these 500 companies has generated over time. And this goes from 1988 to 2025, which hasn't happened yet. So we can see the earnings go up and they go down, but they generally trend upwards. The black line is the price of the S&P 500. So the price of that basket of stocks, of 500 stocks. Now, like even from the back, you should be able to see there's a pretty tight relationship here, right? Because earnings are the most important thing to owners of a company. So sometimes, you know, kind of the relationship gets out of whack, right? Like back here, you can see the black line went way higher than the red line. The price of the stock market went way higher than the underlying earnings. This was the tech bubble of kind of the late 90s, early 2000s, right? Everybody was super excited about the internet, right? Because the internet was going to change everything. People got way too excited too soon, right? They paid more, they paid too much for those companies. The companies weren't able to earn as much as people wanted. And eventually that bubble burst, right? Earnings are the fundamental underpinning of stocks. So that ended in tears, right? The stock market fell. You can't really tell from this chart anymore because it's looking a little, you know, parabolic over there. But this is a 50% decline in the stock market from the top to the bottom, which is super painful, right? But we recovered. We had a little tiny recession. I mean, we had 9/11, like lots of things happening around here. But earnings started to go up again, right? And stock market kind of followed just in time for the real estate bubble, right? So here, instead of the black line going up too far, the red line went up, but then the red line fell as banks, people stopped paying their mortgages. Bank earnings went from very positive to very negative very fast because people stopped paying their mortgages. We had a financial crisis, a bunch of banks almost collapsed, right? Were barely held together by the US Treasury, basically. And it was worldwide, super duper painful, if you remember the financial crisis, right? Again, the stock market fell by half.
It was 2008.
That was 2008, 2009. Stock market fell by something like 52, 53% in less than 2 years. Again, very painful, right? But then eventually, you know, the companies that are in the economy, companies start earning money again, the red line goes up. And this is kind of interesting. The red line's going up, but the black line's not following. So why would that be?
People are scared.
Yeah, confidence. People are scared. Like, fool me once, right? Like 2 times in 10 years, the stock market fell by 50%. This is why people don't like the stock market. This is what people are talking about when they say they're too afraid to invest in stocks, at least from what people tell me. I lost all my money in the tech bubble. I lost all my money in the financial crisis, right? But eventually that black line catches up to the red line. People start getting more confidence that things are going to be okay, that we're going to recover from this. And then we have lots of other things that happen, right?
Sorry. You can't see where you're pointing. You're like, which red line?
It's really good. The giant arrow. Things are happening, right? And then what do we have here? Let's see. I mean, so here is COVID, right? It's March of 2020. It's February 2020, our last in-person AWIC meeting before we don't meet for several years, right?
Yeah.
Earnings fall because businesses aren't open. Stock market falls because, oh my gosh, earnings are going to fall. But it's like somehow we get through it. A lot of government support comes in globally. Earnings start growing again and the stock market follows. And here we are, right? So I've been showing this chart since 2011. And it's always the same. It's like, well, now what do we do? we can see like all of the things. It would have been awesome to be doing all of the right things back here, but now we're here, right? Now we're now. So what do we do going forward? Over here in the red boxes, this is where these are earnings estimates. When you're in the stock market, if you are trying to time this, you are competing with very, very highly paid individuals on Wall Street who get paid to analyze things and forecast things. Anyway, we take their forecasts and we put little boxes here. Very highly paid people think that in 2024, earnings will be here, right? So this year, 2024, and we are already, you guys, we are already looking at 2025. We are not, 2023 is gone, 2022 is gone, nobody cares. We're already looking at 2025. So we're trying to figure out like, I mean, if I'm eyeballing this, right, I'm like, well, maybe the black line has gotten ahead of itself a little bit. That all happened kind of the last quarter. It can happen really, really fast, right? So do we expect the stock market in 2024 to maybe come back down to meet the red box in 2024? Or are we all looking forward to 2025 and it would go up to 2025? That's what we're going to take a poll about. And we're going to determine where it's going to go, right? But this is why the stock market is hard in the short term. And it's why people get analysis paralysis. And it's why you shouldn't do this for the short term. You should not try to figure out when to get in, right? The time to get in was back here, right? And the time to get in is now, because when you come back in 5 years or 10 years, our chart's going to be up here, right? We can eyeball this chart and we can see the trend. And we should be able to say like, okay, I'm in it for the long run. There are going to be terrifying moments along the way, but I'm in it for the long run. Any questions on this? Here, I'm going to come over to Leroy first.
So, do you have a number of percentage drop off in bonus and then the drop off in the most recent one?
Yeah, this was something like 34% in 3 weeks, which was historically fast, right? It was a historic event, obviously, right? 34% in 3 weeks. It was super painful. And I don't know, for people who follow the stock market, during the day, there are these things called, they call circuit breakers. If the market falls by more than 8% in a day, they'll stop trading for 15 minutes to give everybody a chance to like get a drink of water, right? Like take a shot, like hold themselves together, right? Like, do we want to be doing this? Do we want to keep selling? Can we just all chill out a little bit? And then they open the market again. If it keeps falling, they stop it again for 30 minutes to just give people like, stop it, right? Because we're all very emotional. That happened several days in those 3 weeks, right? Like we're all freaking out, like, but so that can happen. The stock market fell by 20% in one day in 1987. That's why we have the circuit breakers, because of that 20% one day decline. And then last year, market fell by 25-ish%, maybe 2022. Yeah, I'm sorry, not last year, 2022. And that one was real tough because we started at all-time highs and we just went down the entire time. We just went straight down. It was like, oh, we're still doing this the whole calendar year. It was really weird. And so then here we're back at all-time highs, right? But like how can you know that over a 1 year time horizon? Like the answer is you can't, right? You can get real lucky. And that's maybe the worst thing that can happen, because then you're like, I got this, right? Any other questions on this? Asusana, you have one, right?
Yeah, you mentioned about, when COVID hit and this, and then that started going down because this is basically into a hole.
Yeah.
And then interest rates were dropped. So I'm trying to understand like how that was able to promote this,
Yeah.
I know there's circuit break, I guess. Is that what you would say?
Yeah, the interest rate relationship. Oh, yes, on the call, the question is about interest rates. If we think back to March of 2020, like how do you stop the panic? How do you stop the markets? And not just the stock market, the bond market, the real estate market was very strange at that time, right? You couldn't go into open houses. But one of the tools they brought out was they reduced interest rates, right? The Federal Reserve comes out and goes, okay, we're going to zero. That makes it so that if you need money, you can go get it for very cheap to bridge from here to there. I don't know what's going to happen. I have to borrow money, or I have to borrow money to make payroll, or I have I don't know what's I need to borrow money so I can keep people employed, or so I can figure out how to get through this time. It makes it less expensive to do that. Anytime uncertainty, anytime people are uncertain, they tend to hoard cash, right? We all do it too, right? And companies hoard cash and then they try to borrow money, just okay, if I have the money, I can figure out what to do later, but at least I have money now. So interest rates helps with that. Yeah.
Because I can't see, we talked about the price on that. What about earnings? Did they project it to go up? No.
During COVID?
No, you said the people that are.
Yeah, this is 2024 earnings that are projected to be higher than they are in 2023 and then 2025 here.
So are both earnings and the price of stock expected to go up?
What do you think? I mean, one of the problems with the projected earnings is what if you're wrong?
Yeah.
There's kind of a double, over a 1 year time horizon, there's a double risk.
Yeah.
Right? It's
The question is, are they correlated? Price goes up, earnings goes up. Well, yeah.
Yeah, they're correlated, right? But they can also, these aren't set in stone. It's not declared that this will be 2024 earnings and these will be 2025. They're estimates. So you can be wrong to the low side or the high side. And then on the stock market price, you can also have this. I mean, what if the confidence piece goes down, right? What if people get nervous about something, right? And the price comes down. So you have those two pieces working together. Right. Inflation, keeps going. Election years, preview of coming attractions. These are what we're going to talk about in just a couple slides. So keep those things in mind, right? What could happen to make this be good, to make this be bad. Yeah, no?
So in the past, 10, 15 years, it seems like there's still, even though there's certainly downslope, but the trajectory is very much golf, what is it?
Yeah,
golf
like a hockey stick.
Yeah, hockey stick. So is it because of the composition of what the S&P 500 represents? Is it because a lot of it are majority tech companies stocks that are represented there, or are we waiting for maybe in the near future there's going to be a more major correction? Because it seems between 98 and 2008 there's a downslope that almost correct the price or the earnings to almost similar level, but then now we are in this crazy hockey stick, I don't know, and there hasn't been a significant downslope in the past 15 years.
Yeah, one, because this is on a linear scale and we're trying to describe something that is exponential, part of the chart is starting to look out of whack when it's just the way it's put on the chart. If we showed a logarithmic scale, it would look not so hockey sticky.
Okay.
That's one thing. Your question about what is the S&P 500 made up of is very interesting to think about. What are the largest companies in the S&P 500? Apple, Amazon, Google, Berkshire Hathaway, Meta, Nvidia, and maybe Tesla. Tesla's maybe not in the top 7, but all of those companies, do they make money? Yes. They make so much money, you guys. They make so much money. And so we figure out, is that, do they make a sustainable that much amount of money or not, right? There are a lot of people who are these companies can't earn that much money forever. It's unsustainable. I mean, you'd have to explain to me why, right? Because on the other side, there's people who are in technology, there's like this idea of winner take most. And then how do you catch up? How does anyone catch up, especially in the era of artificial intelligence, which is all data? Who has the most data? All of those companies that we just talked about. How do you catch up, right? It doesn't mean like no one will catch up. Like you still have in the US, capitalism, we're incentivized to capture profits. We're incentivized to start a company that will take the profits from Google and keep them for ourselves, right? So maybe someone will do that, but it's really, really hard and really, really expensive. Yeah, Leora.
I thought I'd highlight something since we have to work for this, but the S&P 500 is like, you kind of get into the group, the 500 group, the group that's not static.
Yeah.
So this is like just showing what those tech companies did over time, like prior to 2008, probably even to 2008, from the companies that made up the majority of S&P 500 were tech companies.
Yeah.
There used to be autos, and oil and gas.
Right.
People don't say that. Never thought Ford could go under.
Yeah,
Never thought
totally.
oil and gas companies could
Like,
go under.
the biggest companies in the world in 2007 and 2008 were financials.
Yeah.
Because they did mortgage-backed securities, which created a whole industry, which then killed them, right? So you're right, like these things change over time. But the idea is, if we think in the aggregate, without even worrying about who the companies are, if we do come back to the idea that where we live in the United States, this is the system that we live in. This is the incentives that we are given, is to create companies that can make money, right? And that is what the stock market is. So people who are like, oh, it's, it's just gambling, it's a casino. In the short term, I think that's kind of true. But over the long run, it's companies that are good at making money, their stock price will go up. Companies that are not good at making money will die and be replaced by someone else. So that's kind of where this earnings idea comes from. All right, we can come back to it if we have more earnings questions. Oh, and there's also like, when you look at this, they're like, where do these numbers come from is down here in footers.
I have a question on this slide.
Yeah.
Not to delay the conversation, but I know that you have been doing this for like a while, and like you can discharge, like for several years. So historically, how do you feel like the prediction that they have for 24 and 25, like how do they work in the future? So like, for example, if you look at the previous one, like how close related were them? And there are times as well that they also like predict, like a drop like on earnings per share.
Yeah.
Or is, let's say, 50 or 90% of the time they always like predict to go higher, and then they miss completely when you like goes higher.
Yeah, what a great question. I mean, they're pretty crappy at predicting, right? Like, I mean, pretty much this chart always looks like this. It always looks like two boxes that are higher in the next 2 years, almost always. And so, I mean, like COVID, right? COVID went the other direction. COVID was the exception, because when we looked at this chart, the predictions were, where's COVID? Here? Is this one, Gwen?
Yeah.
The prediction was, oh my gosh, earnings are falling. Earnings predictions were like down here, right? So what we tend to do, I think, because we're humans, we have recency bias. Whatever's happening now, we predict will happen in the future. So we can't see the terms. That again is why the short-term predictions is so fruitless for most people. We just take what's happened and then we say, oh, it'll probably just keep going that way. But then something turns and we're not ready for it, right? And then it freaks us out because we were wrong. And so that's why, like, if you're looking for like when to get in, it's either when the market is up and we're at all-time highs and it feels safe to get in, but it might not be. Or, I mean, when the market falls, I know this because Sherry, we were at our 2022, little gathering, like eating cupcakes and like crying about the stock market, right? No one was like, you know what, I'm all in. We were all like, oh, we'll just hang in there.
And I remember when we're predicting, everybody said no good of 2023. Only one lady said it's good. I want to know who that is.
So we can make some predictions. I do want to synthesize this in the group. I'm just showing you this chart for context. Price volatility as earnings and confidence expectations change, which we just talked about this. This is a 2-year price chart. The green line is the S&P 500. The blue line is the NASDAQ, which is more tech heavy. And the purple line is the Russell 2000, which are small companies. I mean, this is like 2 years ago, we are kind of back to where we started. This, like, the market had started declining 2 years ago. I mean, look at this volatility. Like over here on the percentage basis, like, look, we were down, we were down 25, 35% on the NASDAQ, and then came all the way back. We round tripped. I keep hearing now from clients, people are like, oh, I feel like things haven't changed for 2 years, right? I'm like, well, it's like, we're back where we started 2 years ago, right? But you kind of forget, like, oh my gosh, like we went through a lot in 2022, right? So this is our 2 year, and this is over this entire time, earnings expectations and confidence are changing, right? Like confidence changes with inflation. That was the 2022 story. Oh my God, prices keep going up. How am I going to pay for all this stuff? People do not like that. Investors don't like it. It's uncertainty. Prices decline. Yeah.
How much does M&A impact the earnings and expectations from a volatility?
Like mergers and acquisitions, not that much, because there's not that much. I mean, there's a lot of activity in the S&P 500. It's not that much. Good question though. All right, so this, like, the takeaway here is there's just a lot going on in the short term in the stock market, and that's never going to change. Some people are like, I mean, I heard this so often in 2022. I'm just going to wait for things to stabilize. Now they're stable, right? But like, I think like as stock investors and as a financial advisor, I feel like my main job is to talk people out of selling, right? Here, that's like the main thing. If we're in it for the long term, like just hang on when things are really, really bad. The rest of it, but like when to get in, like you pick whenever, like whenever you have money that you can put at risk, like with price increases and decreases for 10 years, then whatever time that is a good time, right? And that's probably dependent on you. How much money do I have that I can put into a time capsule and shoot into the future 10 years and forget about it and don't look at the stock market. Don't come to any more meetings. Just come back in 10 years. Right? That's like, those investors are the best investors. They did this, sorry, one thing, and I'm getting a little bit off topic. They did this study at Fidelity where they found like the best performing accounts were people who had died. Right? They didn't change anything. So we can just play dead, right? All right, next. Okay, in case you missed it, let's get in the Wayback Machine. This is a picture we had. You guys, was anyone at the New York Times when the New York Times came?
That was the last meeting before we went.
The last minute or last meeting before. Yeah. So if like this is like the default look whenever we're talking about stocks. And this is a New York Times article that if you haven't seen it, like send it to me. I'll send it to you. It's awesome. It's about Austin's investing group. All right, so let's go forward and see what have we talked about in the past. We'll just kind of jam through this pretty quickly. And really this is to like give you an idea of what we've talked about in the past, words that we can use when we think about 2024. So poll results from January 2023. So this is 1 year ago. Why might the stock market do well in 2023, right? Sherry remembers one person actually thought it was going to do well. But if we had to come up with something, the word cloud, the way it works is the more people who use the same phrase that those words get bigger. Does that make sense? So just keep that in mind as we go forward. So we kind of all said like, okay, if the Fed stops raising rates in 2023, that's probably going to be good for the stock market. Rebound is a big one. And then there's a bunch of like kind of other little ones, right? Like we're past the fear of COVID, things get resolved. Recession's not as bad as everybody expects. So what were our poll results about why might the stock market do poorly in 2023? Recession. Do you guys remember there were like some people like with 100% probability of recession in 2023? Yeah. Recession was what we were all talking about. There's a lot of political words up here. Inflation was, we had just come through 2022 with the inflation story. So that was still top of mind. Bad companies die off. I don't know what that one means, but it's big and people thought about it. But inflation was the big thing, right? Because again, recency bias, we were still traumatized by 2022 inflation. All right, next. And then we just kind of keep going back, January 2022. Trying to think, January 2022, we're at all-time highs. Right, remember 2 years ago? So why did we think the stock market might do poorly in 2022? And it did do poorly in 2022, Fed rate hikes. Nailed that one. Next one. Why might the stock market do well in 2022? Like we were all coming out of COVID, right? Oh, we're all gonna spend so much money in 2022 because we're over this, right? TINA stands for there is no alternative. Interest rates are low. What else are you gonna do with your money? You can get 0% in savings, or you can chuck it in the stock market. That unwound itself very, very quickly. Next, we keep going. January 2021, what was happening? We had just come out of an election, right? That happened, yeah. Elections happened at the end of 2020, right? New administration coming in. Why might the stock market do well in 2021? Technology was a big one. That's interesting. Stability, right? Just like this feeling of like things are getting more stable after a traumatizing 2020. Why might the stock market do poorly in 2021? What did we think? Oh, and coronavirus is like all up in there too. Why might the stock market do poorly in 2021? Civil unrest. This was after January 6th, right? 2021. Overvalued stocks.
Yeah.
Oh, that's right. Yeah, because that was the, yeah, we were talking about how stocks might be overvalued.
Yeah. It was.
But the stock market did okay in 2021.
Yeah,
right?
Even
Even so.
Yeah.
Yeah, it's interesting. All right, next one. Way back machine, January 2020, before COVID. Why did the stock market do well in 2020? Oh my gosh, we were all like such babes, right? Optimism. Oh my gosh, momentum and FOMO. Trump was good for the market. Election year was good for the market. War was good for the market. People were talking about 5G. People don't talk about 5G so much anymore. Why might the stock market do poorly in 2020? Coronavirus, COVID, Bernie? Trump again, bad and good. Election, right? So this is what we were talking about in 2020. So and like in 2020, we kind of nailed it both ways. It was really bad, and then ended up being fun, right? So it happened all in the same year. It was the news was this meeting was in January. There was already news about it. Yeah. So there were enough people in the room who were alarmed, right? All right, next. All right, so how do we think? Yeah.
Here we go.
I have a quick question.
Yeah.
It a lot of the articles was very focused on events in the US in regards to the impact on the stock market. So how much weight then do you give international events like elections in other countries, how that would affect US companies and their earnings?
Yeah, very little. The US investors in the US in general, it's very US centric. It's the biggest market by far. Yeah. Biggest market by far. And almost never affected by things overseas, unless it's another big economy, like the Eurozone, China sometimes, but not very often.
What about with de-dollarization?
Oh, let's come back to that. That's kind of a separate thing that in the queue that we can come back to, like the dollar thing. Okay, so we pay for this over here. So if you get your phones out or use the QR code, if you can text your vote to this number, the idea is like you put in this number in the top, and then if you text the number 1, it'll vote for great. If you text number 2, it'll vote for good. If you text number 3, it'll say fine. 4, not good. 5 is bad.
Educated opinion.
Yeah, it doesn't matter. We're all investors. Everybody's opinions matter.
It's just an opinion.
Yeah,
Right?
yeah.
Exactly.
And we're never gonna know who is right or wrong, right? So it's just like getting the temperature of the room. How do you think, based on what you know now, how will the stock market do in 2024? So we'll give this like, I don't know, maybe another 30 seconds.
When are the online folks voting too? Yeah.
It sounds like it's going to be right.
You got
Crystal ball.
Yeah, this is the crystal ball. People are always asking me. I'm asking you guys. What do you think?
Very promising.
Yeah. Are we gonna be
I
okay?
like that nobody chose bad.
I know, I'm kind of surprised.
You know what I think that way.
Is everybody waiting to see what everyone else votes and they vote the opposite? You could do that too. I think we have it set up to do it again at the end too, once we go through a few more things. All right, so we'll close up voting. All right, it looks like we think things are gonna be good, between good and fine. Yeah, all right. That's cool. Thank you, Glenn. Yay. All right, why?
Oh, no, we can compare one.
Why might the stock market do well in 2024? And this is, I'll say, like, if you can pump the brakes just for a second, if you see a term that pops up that you agree with, if you use the same term, then the bubble will get bigger. If that makes sense. So, well, someone has to go first. So some people have to go first and other people have to add theirs. All right, so we have real estate, we have AI, low interest rates is in there, inflation cool down, Biden out, election, overconfidence, like people,
How was the interest rate one? Yeah, there we go.
low interest rates, lower interest rates. Oh, cool. Oh, more AI with a little baby eye. Fed rate drops. Momentum and high US oil. Momentum's a. We had a great 2023. Tech growth. Fed plan worked.
Yes.
Antidepressants. Trying to think of, let's see, other ones. Consumer spending is on there. Lessons from COVID. All right, so I'm seeing some trending, lower interest rates, word bubbles. AI is in there, which I'll kind of lump in with technology.
So is there any correlation between, like, right now you can get, you know, a CD for 6%, right? 5%, you can get good rates on. Is there any correlation between when there is good earning potentials in those type of investments that correlates all to how the stock market does?
It's a really good question, and I don't have a chart on it. I have some ideas about it, just anecdotal ideas, being when people can earn money on their emergency funds, it makes them feel more confident to take more risk.
And be more willing.
Which
to
is
get into the-
counterintuitive,
Right. Because everybody's saying low interest rates, and I'm thinking, yeah, but we're able to save at higher interest rates than we have in years.
Yeah,
right
there
now.
is a very,
But it's not a tomorrow one.
it's very, very difficult to, in short term, figure out the correlation with rates and the stock market. There's probably something there, but it's pretty difficult to figure out. All right, thank you, everybody. All right, so it looks like lower interest rates. We're all looking forward to lower interest rates and AI.
Yep.
All right, why might the stock market do well in 2024? Okay, great, thank you, everybody. All right, so these are the bullet points that I made ahead of time, right, without knowing what you guys were gonna say. So this is the bullish case for stocks. Bull means prices are going up, right? So you think of the horns, like, you know, like the bullish case for stocks. A bull market is a 20% increase in price of something. So we always talk about bull markets in stocks. There could be a bull market in real estate, bull market in whatever. So this is like the case for stocks continuing to go up. My first bullet point is the US economy is still growing. If the economy is growing, the assumption would be that the companies that make up the economy are also growing. No recession in the forecast. I have a chart on that. Inflation is trending downward. I have a chart on that too. Earnings are trending upward. The Fed stops raising interest rates. That's a guess.
That's a guess.
That's a guess. Does anyone follow the Federal Reserve?
Oh, yeah.
Yeah,
All real estate.
a bunch of nerds follow it, a bunch of real estate people follow it. Jerome Powell, not literally every month, but almost every month, the Federal Reserve puts out, they tell you what they're talking about in their meetings, and Jerome Powell will get in front of everybody and tell you what they're talking about as far as raising the federal funds rate, which is a very, very short-term rate that other rates are keyed off of. So it seemed like his last speech, he was saying, we're going to see how things go. If inflation continues to come down, maybe we don't raise rates more. And then everybody got really excited. And then everybody thought, oh, that needs cuts, which is not what he said, but that's all right. Consumers have jobs, low debt, and cash in their pockets. Eye charts. Technology-driven innovation is just getting started and is disinflationary. So AI, robotics, et cetera, that would be a long-term trend where I'll get replaced by robots. That is very cheap. Yeah.
Maybe I'm just on LinkedIn too often, but I feel like everybody's complaining about not having jobs right now, everybody's getting cut and not having cash. So am I just like getting pulled into the LinkedIn?
I mean, this is really tricky, like who we're surrounded by and then what the statistics say, right? Because this is what, as investors, we all have to be very aware of. Who are the people around us, the industry we're in, the political circles we run in, where we get our news, and what do the statistics say, right? You should be able to back up everything you think if you're going to make an investing decision on it with a statistic, I think. And almost no one does that. We almost always go on vibes. So I put it in a bunch of charts. I asked Glenn, I'm like, should we put in more charts or less charts? She's like, I think more. So I didn't even add all the charts I wanted to put in. So if we have a question, we might have a chart for it. But let's see what I actually included when I put together the charts that I wanted to talk about. These are charts that I think are interesting. And I also think are counterintuitive to what people think or what people tell me, right? I talk about this stuff a lot, like because it's my job. Okay, so over here, there is something called GDP Now. The Federal Reserve Bank of Atlanta tries to keep track of how fast the economy, gross domestic product. So that domestic, US, right? How do we think the US economy is growing or shrinking? Is it a positive number or a negative number? Positive number is growth, negative number is recession, right? So there's someone keeping track of this. So you can download the Economy Now app from the Atlanta Fed website, and you can get updates whenever this updates. So they're tracking, the green line is the Atlanta Fed in real time, because the official numbers are a quarter old, right? So we still haven't announced last quarter's GDP, but this is an estimate of what we think it's going to be. So the green line keeps coming in solidly above zero. For those of you in the back, this is zero. So anything above it is growth, anything below it is recession. The blue line is what people thought, what like very highly trained, highly paid economists thought, right? So economists are like, we think the economy is going to grow, but slowly. The numbers are coming in hot. They're coming in high, right? That's the green line. So you can get this data. It exists. They're collecting it. So this to me does not look recessionary. And last year, we talked about this at the last meeting, didn't we? That people were talking about recession and there was no actual data pointing to recession. There were lots of vibes and lots of conjecture, but no actual numbers pointing to recession. So here we'll see what happens when they actually announce the numbers. I thought it told me when they, the first GDP Now forecast for the first quarter of 2024 will be on Friday, January 26th. So if you have the app, you'll get an alert on your phone. Over here, consensus GDP forecast. Going back to forecast, not really being very accurate. I just did want to put this in here. That the chart always looks like this. It always looks like it's going to grow moderately, right? The line going up means growth. The actuals that come in, nobody predicted this, any of these. Nobody predicts a declining recession. We always say, it's going to be fine. You know, they're going to grow by 7%. That's always like the magic number. So here, there's no recessions being forecast either.
Is that the same confidence here?
this is, yeah, this is 2024, or this is calendar year 2024. That is last quarter. So this number is for the end of the year 2023.
Right, that's September at the beginning, what's that at the beginning of the
Here, 1997. So here, like, okay, is the economy growing? Like, again, like based on where you get your news, I hear a lot, you guys, I talk to a lot of people. I talk to a lot of different people. I often hear like, oh, the economy sucks. It's like, I mean, it sucks for some people, right? Like it sucks, like if you're in a certain industry or, then it might suck for you, but like by and large, it's growing. And that might be kind of a hidden, it might be hidden to you, right? Yeah.
Yeah, can I add a comment to that?
Yeah.
So I went from one industry to another, and in the previous industry it was clearly shrinking.
Yeah.
because it was, you know, leadership and development, and companies are not investing in that right now. And then I moved into more energy, renewables, and AI, and there's so much money there to be spent, and they don't even know what to spend it on.
Yeah.
And so, there is money.
Yeah.
It's just maybe it's reallocating
Right.
around, you know, commodities.
Yeah.
And such, right?
Really
So
good
it was
point.
interesting, like scarcity to abundance.
Yeah.
And based on
Yeah.
where you are in.
And all of that gets lumped in here, right? These numbers take both of those things into account, right? That this industry is being balanced out by this one, right? So that's where the having the numbers is important to put things into context. All right, next one. What else did we do? Okay, this is one that I get pushback on a lot. Households have a relatively low debt as a percentage of income. Another common thing that I hear is people have too much debt. They don't, in the aggregate. So this is how much, like as a percentage of income, this is how much debt, this is 15%, 16, 17, 18%. This is how much debt people were carrying from 1980 until about like kind of I don't know, this goes into 2013. People used to carry higher levels of debt. Then it starts trending down, and then it really trends down during COVID because we all got checks and people use their checks to pay down their debt.
There's nowhere to go.
There's nowhere to go, right? So people paid down their debt, right? Like this is what the chart is like, paid down their debt, and it's come back, right? It's higher than it was, but it's still relatively low. Yeah.
That is trapped here. Because, I mean, do you feel like a couple of weeks back, I just read a report that US has like the highest number of like consumer debt by credit card that we have ever seen. So like, you know, like that number is concerning, but then like looking at the overall graph, like still like relatively like low. I mean,
Yeah.
it's higher than what it was in 2020, because you say that everyone paid off with that. So like there has been like a big spike right there.
So this measure shows the percentage of monthly after-tax income that the average household pays for fixed recurring monthly obligations, such as mortgage, car payment, utilities, real estate taxes, things like that, like recurring payments. I would say like whenever you're looking at stats that are, it's a chart of dollars. This goes to like national debt numbers, consumer debt numbers, all-time highs in national debt, all-time highs in consumer debt. I think it's important to put that in relative to something else, right? So if people have the highest amount of credit card debt they've ever had denominated in dollars, what does that look like versus their income? What does it look like versus their assets, right? Like you have to compare it to something. An absolute number on its own is less helpful than comparing it to something, right? And like the classic one that I don't have a chart on it, the classic one is the US debt. The US debt's at all-time highs. What's anyone know what the national debt is? 34 trillion? Let's just say it's 34 trillion. I think that's actually pretty close. That's a big number, right? People are always talking about how big it is. And people are always talking about like, oh my gosh, like we can't pay our debts. A, we can, and we do. B, what is that debt compared to the US assets? What's the value of the assets in the richest country in the world? it's like 170 trillion, right? So when you put it into context, you get more information. Because that's real, I mean, that's an interesting number, right? And it captures your attention. And then if you can find one more piece of information to put it into better context, it'll help, right? Because it might be like, oh, like consumers have the highest credit card debt they've ever had and incomes are falling. That's bad, right? But they're not, incomes are going up right now. But if that was the case, you'd be able to stop that divergence and be like, ooh, that doesn't sound good for an economy. So that's a really good question. Again, it's why it's like so many economists in the world are gathering information and putting it into all of these different charts and graphs. There's some really interesting stuff out there. There's also total garbage out there, just really bad charts. But this one I thought was interesting and unexpected.
We have a question from online. M says, is the household rate highly driven by mortgages?
It might be. So it could be everybody refinancing into their low interest rate mortgage and like kind of locking in that low. And why this number is important is it means that households have more money to spend on other stuff to keep the economy going, right? Spending is the lifeblood of an economy.
So I correlate with what you're talking about because it would be all the consumer goods you would put on a credit card. Right?
Oh, yeah. As long as you can make the payments, it's okay. As long as you have jobs. But it can, like, if you knew that number and you saw unemployment rates starting to go up, you might be like,
Because to me, like, when, like, thinking about investing, was again, I would like investing, so it was so take this as a grain of salt, but to me, it was like, if the consumers have, like, the highest number of credit card debt, AI is taking away, like, the low-paying jobs. There's a lot of jobs on the market that people are qualified to take, so what does that tell me? That, like, the people there, like, like, the lower, like, the middle class is, like, expanding, and, like, how are they gonna pay, like, the things that they have? So then, like, consequently, like, they're not gonna have, like, the best jobs, they're not gonna, like, meet your direct credit card debt, they're not gonna get trade their houses, so, like, the bubble is, like, like, starting, and, like, people that have more money, like, might be, so I'm like, how does this, like, affect the stock market? I don't know if we'll get there, but, like, it's definitely something that I'm like, okay, how would, like, that in the big picture, like, play out? Long term?
I think that's really good. I mean, I would look at the next thing, which I actually have a chart on, but it's not up here. What percentage of each income, like low income, middle low, middle, middle high, what percentage does each group spend? Wealthier people spend more money. So this is like not anything but a financial observation. That if lower income people lose their jobs to AI, it has a disproportionately low impact on the overall consumer spending. Which is not like, not good, right? But is a number. Next one. Long-term earnings trend, right? So coming back to like the important, like one of the most important numbers to the stock market, long-term earnings. What is left over after companies sell goods and services, what's left over at the end of the day? This goes all the way back to what, 1930 something, this is 1940. Companies in the US are just really good at making money. There's always a recession in the works sometime in the future where revenues would go down and earnings would go down and we go through a business cycle. But by and large, like this is a pretty compelling trend. This looks really rough, right? Again, financial crisis looks very bad. And there are some precipitous declines, but over the long run, it looks pretty compelling if you have 10 years, right?
The log scale chart, right?
Yes. It's easier to look at on the log scale. And these blue lines are recessions, right? Recessions are bad for the stock market because earnings go down in recessions. All right, what's next? Oh, inflation chart. I'll just go through this really quickly. This is the PCED. Oh my gosh, I'm blanking on personal consumption expenditure data something. Now I'm forgetting what PCED stands for, but it's the inflation measure that the Fed looks the closest at. So if the Fed is making decisions about interest rates and you are concerned about interest rates, you should be looking at the measure that the Fed is looking at, right? As to whether to keep interest rates where they are, raise them because inflation is coming in hot, or reduce them because inflation is coming down quicker than expected. So we can see here, this is inflation back to January 2004. Inflation spikes all the time. This is extreme, right? 2022, yay, you know, but now we're here. So again, the stock market is forward looking. What do we expect inflation to do in the next year or two? It looks like it's coming down. This is what investors are thinking, right? They're looking at this chart saying that looks like it's coming down. Then over here, I thought this chart was interesting. Do you guys know about the 2% target that the Fed has for inflation? Does that ring a bell? So the Federal Reserve is trying to get inflation to run at about 2%. That's its target. This goes back to 2010. We can see here, so the bottom dashed line is a 1.5% inflation rate, and the top one is a 2% inflation rate. So we were below the Fed target forever until COVID, when everybody got checks and then everybody started spending money and then the supply chain broke down. We just had all of these confluence of things that happened in 2022. And all of that led us back to the 2% target over that long period of time. So it's like inflation, instead of running at like a steady pace over this time period, was like below trend, below trend, below trend, below trend, spike, right? But it kind of just got us back to where we would have been if we had run a 2% inflation target that whole time. I don't know. I think that's interesting. All right, next. All right, because we still have to do our, why might the stock market do poorly in 2024? All right, same thing, word bubble. So now you're like, oh, like what could derail this, right? We're at all-time highs now. I don't think the stock market will do well. Why? Why might the stock market do poorly in 2024? So what would cause you to lose confidence? What would cause people to lose confidence? Or what would cause earnings to go down? Unemployment, political divisions, election, Biden wins. So high already, so like all-time highs, inflated prices, inflation was in there. Rates don't drop. Election, I'm seeing a lot of election. War could break out. Or, I mean, there are wars happening now too, obviously. Trump wins, election Trump. Seeing a lot of Trump and Biden election related stuff. Boomers retiring, interesting. Consumer debt, ooh. Another COVID scare. All right, keep it coming. Did I already say political divisions? That's up there.
Yeah.
US enters war, government spending.
Yeah.
All right, really good. All right, let's give it another 30-ish seconds. Do you have any more? All right, really good. All right, so we kind of have like a gauge of what everybody's thinking, right? What are people concerned about? I think that I'm reading this correctly, that a lot of it is election related. All right. All right, thank you everybody for sharing. That's awesome. All right, again, these are my bullet points that I put together. One, inflation could continue to stay higher than the Fed wants, leading to further rate increases. I think you guys captured that in the word bubble. The Fed will continue to raise rates until they break something. The idea is this has kind of run its course. This was more of a theme last year. Is the only way to bring inflation down by causing high employment, causing a recession? The opposite of that is now, like the word that everybody's saying is soft landing, right? Soft landing or no landing. Inverted yield curve. Do you guys remember we talked about the inverted yield curve in 2018? I'm bringing it back. The long-awaited recession arrives, right? And we didn't forecast it. It just lands in our lap and it's sad. Vibe session and sentiment, that's just like the feeling that things are bad, right? People just aren't feeling good. Near all-time highs, we have that in there too. Time for a pullback. It's a perennial favorite. Stock valuations on the S&P 500 are too high. I think someone mentioned that one too. And then the national debt, too much debt, and projected deficits. Yeah. Some of these are bullet points I use every year. I only update a few. You guys go back, like it's the same thing over and over again most of the time. Vibe session is new.
So what are your thoughts on this? So I read an article that said the economists say that they're perplexed because we're in a first time situation where the national debt is the highest it's ever been, but yet the spending and earning continue to go up. And typically, if the national debt is high, you're in a recession or the earnings are low and there's not as much spending. So they're stumped as what to project because of that situation.
Yeah, I mean, I think that people forget that government spending is a component of GDP. If the government is putting money into the economy, that is money flowing to private businesses. So if you think about the Inflation Reduction Act, it's a bunch of money going to build out infrastructure. That money is going to companies and employing people and keeping things moving. Do you guys remember after the financial crisis when Ted Cruz first came to power, the Tea Party, austerity? That suffocated our economy. Austerity will suck money out of the economy. That's why politicians don't typically do it when they're in power. Putting the government spending adds money to the economy. And so I think that that's like where, like, I really think like that's where the disconnect is that if you reduce government spending, you will pull money out of the economy. It will slow the economy down, perhaps cause a recession, which is why it has been a long time. I don't even remember if I can remember a time when the party in power has actually done it. Nobody does it. No. It's a component, if you like GDP, it's a component of GDP. Yeah.
I have a question on that. So like you're saying that like it's calculated in GDP because it's like technically like spending the economy. How, because I know that like part of like, you know, like how we were about to have like a government shut-out, like in a couple of weeks, but then like really like, you know, like on a couple of issues and some of them being like, you know, like lending or like giving money out to like foreign companies, like how does that impact? Because like that technically like comes out of our debt and, you know, I'm assuming that it's a small percentage, but it's still like a significant amount of money that technically, you know, if it's like 5%, if like year by year we have like a 5% increase, technically then we're negative with inflation and that money is not in the economy here. Now it's going elsewhere.
It's all relative, and you're right, it's such a small percentage that it doesn't matter. It's a political football, right? What are like you guys probably know this, what are the largest by far components of the national debt and the deficit? Social Security, Medicare, defense. And now it's interest on the debt, a distant fourth. Who wants to cut Social Security? Who wants to cut Medicare? Who wants to cut defense? Yes, we gotta vote over here. We'll vote those people into office and have it actually happen. It never happens.
Never happens.
Ever. Yeah.
What are your thoughts on how the world moving to a digital currency?
Can we come back to digital currency and crypto? If we have time, other we have to punt it to our digital currency and cryptocurrency. Because they're really good questions. I'm going to keep going here so I can make it through my slides by 4:30, and then it's going to beep and it's going to scare us all. But I think I can make it through the slides, and then we can do some Q&A after that. Okay, so here on the bearish side. So there's something called the Conference Board. They do this leading economic indicators chart. It's supposed to show us when a recession is coming. Leading indicators means like we're seeing into the future. So the LEI is very negative. It's the blue line here. So the blue line is supposed to predict when GDP falls and there's a recession, right? And we can look down here, it's a pretty good indicator. Leading indicators show that a recession is about to happen, except now. So going back to things that are confusing, it looks like that blue line is telling us there's a recession coming, but the GDP line is going the other direction. So we have to figure out, like, okay, is this just a matter of time? Again, coming back to like, oh, the recession is coming, it's just not here yet, or is this time different? So this would be something I would look at and be like, oh, am I willing to say this time is different? I'm not gonna answer it either. You guys have to figure it out for yourselves.
Sarah, where can we find these charts?
Down here, like there's, yeah, the source is down here, and I'll send this out, right? So this is, you can go to the conference board, they publish it. Next. Ooh, inverted yield curve. Okay, so when long-term rates are lower than short-term rates, it's weird, right? If I'm gonna lend someone money, I should get more interest for lending for a longer period of time. When that's not the case, like it is now, it tends to be a predictor of recession. It's indicating that something's wrong in the economy. Why would I accept 4% to lend at 10 years, but I require 5.5 to lend for 6 months? It's weird, right? And so that weirdness tends to predict recessions. So this is showing here, and this is 0. The red line is 0. So when it falls below the X, Y, which axis is that? X axis. It's negative. So here, the red line is very negative. We have a very inverted yield curve, but no recession. That would be the blue line, and the stock market is going higher. I mean, I have, like, if you're bullish on stocks, you would say, well, the yield curve is assuming that inflation keeps coming down and interest rates will come down in the future. If you're bullish, or if you're bearish, you would be like, the yield curve is going to predict a recession. We just don't know it yet. Oh, bear is prices going down 20%, like a bear pause swiping. Price to earnings ratio, a measure of cheap versus expensive. So that idea is something overvalued or undervalued. Typically what we use is something called the price to earnings ratio. The price of the stock or the basket of stocks is in the numerator and earnings are in the denominator. So you can kind of think of it as price per square foot of a house, right? That's how you would compare two houses sitting next to each other on the street. This one is selling for $500 a square foot. This one is selling for $400 a square foot. Why? Is there a difference? So this is the red line is the S&P 500. So that's large companies. The blue line is the S&P 400, which is middle-sized companies. And the green line is the S&P 600, which is small companies. So if I'm just eyeballing this, it looks to me like the red line is higher than its long-term average, lower than its recent average, and the blue and green lines are lower than their long-term average and lower than the red line. So if I'm just eyeballing this, I might say, instead of buying large companies, which might be overvalued relative to smaller companies, maybe I would buy smaller companies because they're undervalued relative to larger companies. That's how you use the PE ratio. You take the PE ratio and you compare it to something else. So there's some evidence of overvaluation here. All right, next. Okay, so I'm going to back up a little bit and say, like we talked about analysis paralysis and investors often waiting for the perfect time, right? There is always a crisis coming. We just don't know what it is yet, right? There's never, ever a perfect time, ever. So this says there's always light at the end of the tunnel. Through wars, assassinations, bankruptcies, and crashes, the US stock market has always gone on to make new highs. A wise investor once said, never bet on the end of the world because it only happens once, right? So this is showing all of these different very, very bad things that have happened from 1928 until now, right? Very bad things are always happening and they're always going to happen. It's just humanity, right? So if you're waiting for the perfect time and you're waiting for all of these things to get resolved, you're never going to get in. So just hold your nose, right? All right, next. There's just a couple more slides. Oh, this is the all-time high ones. Here's a chart going back to 1950. So the green line is when the stock market is within 1% of all-time highs. The blue dots are when it's within 5% of all-time highs. And the yellow dots are when it's within 10% of all-time highs. Because the stock market trends upward over time because of earnings growth over time, 63% of the time, you're within 10% of all-time highs. So all-time highs it's not the norm, but it's not uncommon. 20% of the time, we're basically at all-time highs. When I saw this chart, I was like, what? That can't be. But it is, right? So if all-time highs is too high for you, you're not going to be in the market when the market's trending upward, right? Like you're never going to get in, because the alternative is to wait for it to be 20% down or, something like that. And then you're going to be too scared. So most of the time, the stock market is relatively close to all-time highs. That to me is like surprising, but makes sense when it's pointed out. All right, next. Okay. If you don't like stocks, what are the alternatives? I'm just going to go through this one really quickly. This was actually our last newsletter, so I can send you our newsletter if you want to see more detail. The green line back to 1993 is stocks. Yellow line is gold. Purple line is bonds. Blue line is real estate, residential real estate. And the gray line is commodities, like oil and gas, timber, things like that. The stock market is risky, right? And you get compensated for that, taking that risk with higher rates of return. So if you're trying to figure out option A, option B, there aren't a lot of option Bs if you want to make money. Maybe leveraged real estate, like using loans to buy real estate. But if you're like looking like, oh, should I buy stocks? Should I buy gold? Should I buy stocks? Should I buy bonds? Should I buy stocks? Should I buy commodities, oil and gas? This is the chart to check out before you do that. All right, I think I have one more. All right, that says the most important chart of 2024. And it says, don't get political, right? This is like an in advance warning, right? Because the inclination is going to get stronger and stronger as we go through the year. So I have two charts here. This one over here, $1,000 invested in the S&P 500 since Eisenhower was inaugurated in 1953. If you only invest when there's a Republican in office, your $1,000 turns into $27,400. If you only invest when a Democrat's in office, your $1,000 turns into $52,10. That's not supposed to be like a, one or the other. It's not like this is non-political, right? But check this one out, you guys. Invested across all presidents. Invested across all presidents. The only thing that I hear more often than I sold all my stocks during the crash and lost all my money is I sold all my stocks when the guy I didn't like was elected and didn't get back in. That's the second most common thing. So just keep this over here. $1,000 invested when Eisenhower was elected into office in 1953. That says $1.43 million, right? If you're jumping in and out based on something political, I would love someone to send me a chart that flies in the face of this, that says, if this guy wins, he's going to tank the economy. It's so easy. You want to so bad.
Question. I was getting wine last night with a friend, and they're having a very similar conversation to this. And ultimately, I'll just throw it out like blue. But we were talking about how Trump or other red folks traditionally do have more positive policies in place for businesses, which equals good for the stock market. So like it might be against my, personal interest, but typically conservative policies support business. So
I'm just putting the chart up here. I'm just putting up the chart. You guys can take the information. I'm at and this is like really super common with investing narrative, something that makes sense to me. Something that seems so simple and it makes sense. And you're like, yeah, that's how I'm gonna invest. Versus data.
Nobody said data.
No, this is like, When I saw this, I took it into Gwen's office, I took it into Casey's office, I'm like, you've seen this? We need to send this out to everybody. Because I'm not having this conversation in November. We are staying invested. I don't care what side you're on, whatever. Yeah. Right? It's so easy. Like, people in financial media and certainly in politics are trying to hook you with emotions, like it's the emotional hook. So I honestly think this is the most important chart of 2024 because it will be so tempting to say, if that other guy wins, we are all screwed. And I'm taking all my money out. Like, I don't trust that other person. And it does not matter who the other person is. Just remember this chart, okay? Just remember.
I want to say I've seen something similar to this, but only in more the linear fashion.
Yeah,
It's the
yeah.
same sort of thing.
It's the same thing.
When it's, and you know, even in history, when it's been just like horrible,
Yeah.
people have just the same thing.
That's why, like, I'm going to ask when someone comes with an emotional reason to sell or buy, show me the data. There is centuries of data. Pull it however you want, manipulate it however you want, show it to me. Like, so I'm just going to show you this because, again, it's like counterintuitive. And I think it's really, really, really important as long-term investors. All right. I think that's it. And all right. Oh, can we do really quickly, see if anyone has changed their mind about the stock market? So remember, we were kind of leaning toward like fair to goodish. All right. Now that we've kind of gone through this, and you guys listened to like my bullet points and looked at the charts and like thought about it a little bit more, saw other people's reactions to the word bubbles. Are we still thinking the same thing? Did something change your mind?
So we should vote again.
Yes, vote again, please. If you could vote again, I would just love to see if things have changed.
No bias. No bias.
Oh, yeah.
Fan of your attention, the library is closing in 30 minutes. The library is closing in 30 minutes. Thank you.
You were great. I think that I always do that though, you guys. I think a little bit of a problem. Those of you who've known me for a long time know that like I get super excited about stocks for the long run. And so I hope that my charts are what caused you to change your mind and not just like my general over my vibes. Yeah, I think we're still kind of close, I think.
I think the good is much better. Than
Yeah, we have a couple greats. I don't know if we had it. Did we have that many greats last week? Well, maybe we're right exactly the same. Okay. That is all I have, everybody. And I also talked for so long, you asked so many great questions that we don't really have time for Q&A. I'm always available. You can find me at Black Farm Financial, LinkedIn, through Meetup. I'm not as good at checking Meetup as I am my own email. And so like if anything pops up, if you have questions, if you want, I'm going to send out the slides so you'll have the charts. If you want to see more charts, I have even more charts that did not make it into the slideshow. So many charts. Yeah, lots to take with you. I'm sorry, short-term predictions are hard. Diversification is your friend, right? So maybe some large cap, small cap, mid cap. You don't have to know everything. Time will, like, if you just give it time, you really can just never come back to one of these meetings. Just chuck it in there and hope that you're on that upward trajectory that we looked at. And spend time on things you can control. We can't control the market. It just does what it does, right? But we can focus on career, investing in ourselves, right? Maybe paying down some debt. This is refinancing debt. That's from last year. That's tough this year. Rates are a lot higher. Pay off those credit cards, things like that. There's lots of things you can control and a ton of things you can't. You cannot control the stock market, but you can be a part of it for the long term. All right, that's all I got. Was there one more? Thank you. Oh, and there's my info. There's my email address. All right, thank you everybody for coming. This was so fun. Thank you for coming in real life. I love seeing all your beautiful faces. Thank you, Gwen. Thank you, online virtual people. Thank you, Lori. Sign up to get the,